How's it going, everybody? Welcome back to Focus Fire Investor Channel. My name is Jamie. Thank you guys for tuning in today. I wanted to talk about a few things on how my accounts are performing right now. I'm wondering how you guys as investors out there are performing. I got a few different things I wanted to go over today with the market and things that are going to be coming up in the next week or two that I think a lot of people should be keeping an eye out for, especially if you're planning on deploying any money here within the next 1 to 2 weeks. So our dividend portfolio here is just over 30,000. Now I recall just a few weeks ago we had literally dipped down. I think it was somewhere in like the 25,000 range. Yeah, there it is right there, 25,400. We're literally talking like, not even a week or two ago. I mean, we're talking about just a few days. So this market is extremely volatile, and we refer to the market being really volatile over the last 1 to 2 months. But I think even more importantly over the market being volatile is which specific stocks you pick in your portfolio and how volatile those are. Because if you are an individual stock picker and you don't have much in ETFs or say like the S&P 500, then you're not really caring how volatile the market is. You're more worried about how volatile your portfolio is. And on top of how volatile the stocks that you own are is the one question you're really going to want to ask yourself, especially for any of the newer people looking to get into the market, or perhaps you just got into the market within the last year, but you've never asked yourself an important question, and that is, what is your risk tolerance to the market? Now, if you're kind of throwing some question marks up there and asking yourself, like, what does risk tolerance mean in relation to being a stock picker or an investor in general? And that pretty much just means like how volatile of stocks you're willing to hold in your portfolio. And honestly, if you can mentally make it through a time when you see negative numbers in your portfolio, picking those more volatile stocks in your portfolio can give you a larger reward. But again, when you talk about risk and reward, that's something each investor out there, myself included, is going to have to accept for themselves and decide how volatile of a portfolio are you willing to accept. Now, one of the things that I wanted to go over in this video, and something I think that could help a lot of people, dependent, who cares how long you've been investing, you should probably reanalyze this every once in a while, in my opinion, is what is your risk appetite for loss or for gains in your portfolio. And that can be that decision, in my opinion, can be aided by something called the Rule of 72. Now, a lot of people are familiar with the Rule of 72, and this is one of the basic fundamentals. A lot of investors like to learn about these types of things. So let me know in the comments below, guys, if you enjoy something like the Rule of 72, me going over something like this and how it relates to you as an investor. So I'll click over here real fast into the Rule of 72 and we'll kind of go over it. Now, I found a cool calculator out here for the people that really don't want to mess with the numbers or try and crunch them themselves. And pretty much the 72 number is what you're going to divide by the percent that you think you can make every year on your portfolio. So on this one, for instance, the interest rate is 8%, which is about average for what the S&P 500, aka the market, will do in the long run. So over a number of years, between the up years and the down years, the average is around 8%, give or take maybe about 2%. So we're going to use 8% in this case, and when you push calculate, you'll see that in about 9 years, your money will double. So the Rule of 72 essentially is dependent on the interest rate, or the percent that you think your portfolio will return on average. Divide that into 72, and that number you will get is how long it will take for your portfolio to double. Now, this is off of MoneyChimp.com. If you literally just go and type in Rule of 72 MoneyChimp on Google, it'll pop up and you can get something like this. And you can see it's pretty fun to play with. Now, if you put 10%, which some years the S&P 500 does, create more of an average, closer to 10% in my opinion, on the more bull runs in the market. There are some crazy years out there where you can, the market will return 20 to 30%. Of course, those are crazy bull run markets out there, and those are not a super long-term trend, except for the one we just had, which was the longest one in history. Putting 10% interest rate in there, you can see that it only takes about 7.2 years for your money to double, instead of the 9 years it would have taken when you had an 8% interest rate. So a little bit less time when you have just a few more percent, something fun to mess around with. But how does this relate to you as an investor? How does this relate to the money that you see in your portfolio right now? And when you're trying to pick the specific stocks that go into your portfolio, how does the Rule of 72 apply to that? Well, This is Jamie talking here, so this is not financial advice directly towards you guys. This is how I am looking at this myself as an investor. When I pick stocks, I look at stocks and I say, okay, what is the time frame that I have to invest with? I think that is the biggest, probably second question a newer investor has to ask themselves. One, what we already went over, which is what is my risk appetite for, reward or risk essentially in my portfolio. And once you can figure that out, you can probably have an easier time frame on figuring out how much time do you have to invest with. And maybe I'd even flip-flop those around. Ask yourself, how much time do you have to invest with before you're looking to retire? Now that is a huge question, because that is going to let you know how many times essentially the rule of 72 can apply over your investing career. So a young investor, say they're 20 years old with the thoughts or intentions to retire at age 60, somewhere around your typical retirement, you have 40 years to invest over there. So all those years you're investing, maybe getting a match from your employers, whatever, and you can say, okay, I think I'm going to have an 8% to 10% return over those 40 years every year as an average. You can start doing the math and seeing maybe what you might possibly be able to come up with, given that's going to be compound interest playing a part, and a large part in growing your money and letting it double every 7 to 8 years essentially, depending on what interest rate you take. So if you were somebody, say, and you're a little bit older, maybe you're in the 30s to 40s, even your late 40s, and you're investing, and you're saying, hey, I don't have the time frame that a 20-year-old has right now. Okay, maybe you have, say, 20 to 30 years, and maybe we'll just say 20 years. That might let you know what type of stocks you might want to pick. Again, this is an individual choice here, depending on what type of money you need to have stashed away in order to retire. So if you use a rule of 72 and you say, hey, in the next couple of years I'm going to invest $100,000, and you only have about 7 years, your money is probably not going to double unless you are going to create some pretty good returns. Now, given the market that we're in right now, how volatile it is, and that we've fallen a little bit, we've taken a little bit of a bigger dip essentially. Not calling this a full-blown recession here, because I don't think we're there yet, but when you invest here at good quality companies in good quality prices, essentially, the returns are going to be so much more substantial. And that's honestly what I'm seeing here, guys, is pulling the thumb of Warren Buffett essentially, is buying at the bottom, selling at the top. Now, not easily done. Nobody knows when the bottom is going to be. But what I've done over the last probably 30 or 40 days here is I've been investing into my wife's Roth IRA, and I've been kind of curious to see how the returns or how the losses have stacked up across my different portfolios. This one you're looking at right now being our taxable dividend portfolio. It's down 11.3% over the all-time. Again, this portfolio was only created last year in March, so literally just a little over a year ago we created this portfolio. We've been able to stash away about $30,000 into it, and over the last day, today it's down about 3%. Last week it's actually up about 1/3%. Over the last month, which has been very volatile and rocky, we're up almost 2%. And again, the main basis or the main purpose of this portfolio is exactly what it says in the title here, is for dividends, and it is to create passive income from the stock market. And that's exactly what it's doing here, guys. This is a more conservative type of portfolio, in my opinion. Has about 30 stocks in here. I'll show you guys those stocks right now. Again, what I'm doing here essentially, I'm just showing you guys in one page all of the different stocks that are held within all of these different sectors in the market here. So when I go through, I'm just showing you guys that only about 2 weeks ago this looked a lot different. And what I mean by that is, I mean here, there was only 3 stocks about 2 weeks ago that were even positive in this entire portfolio. Now we see here, even on a day like today, we have about 3 to 4 times the amount of stocks that have now become positive, and by a pretty good amount here. So last week I believe it was something like Clorox, maybe Johnson & Johnson, and like a Lockheed Martin or something. I can't even remember the 3 stocks that were positive, but it was so few given the specific companies right now that are actually flourishing in this market right now. So I made that last video saying the market isn't really matching what is going on in the actual economy. And now I think it's like it's a little confusing for investors that are getting in and looking for specific purchases, because people are, hitting me up asking like, hey, what about, restaurant companies? I did the video on Darden restaurants. People are asking me about the Cheesecake Factory, like these restaurants that are completely shut down, or at a best case scenario have takeout or curbside pickup. But these companies, like the beach stocks that I had mentioned in the last video as well, some of those companies have been hit extremely hard, but the entire market has not been hit extremely hard. So I think the actual investor that is investing in specific stocks right now is actually at a more of a beneficial gain than the person that is, just putting into the S&P 500. Now, I do want to say, I do not think either one is a bad route. The long-term investor has hands down shown that if you just invest into the S&P 500 or the market, something like a VOO Vanguard ETF, or perhaps a VTI, a Vanguard Total Market Index, that is going to produce some great results for you for a very long-term investor. When I say that, I'm talking about a time frame of anywhere from 30 to 50 years. I'm talking about if somebody was to go and invest at age 20 and just put into the VOO ETF, so that's a ticker symbol VOO, that tracks the S&P 500 with a very low expense ratio, literally stash money as much as you could in there every year, regardless of what the market is doing, over 20 to 40 years, you would probably have, a high six-figure, possibly even seven figures over that time frame due to the magic of compound interest. But I think that in a market like this, with specific stocks, specifically beach stocks and very few others that are down so much, year to date, I think if you are able to pick some of those, you can create some seriously exponential returns. And if you can kind of monitor what's happening in the economy and is it matching what's happening in the actual stock market right here, you can kind of realize like, hey, I think some of these stocks might go down further. Now, that's not me trying to time the bottom. It's me trying to realize what is actually happening like out in the economy and how is it reflecting into the stock market here. We know with the whole virus going around, and we saw Clorox was one of my only positive stocks a few weeks ago. That just makes sense. Like as of right now, my portfolio is only down 4.72% since I started it, and that was just last year. I was looking at my 401k, aka my thrift savings plan, and it's down about the same over the last 12 months. So that's taking the end of 2019 and the beginning of 2020 here being super volatile and not so sexy of a market, and we're talking about just minimal losses here overall. When I was expecting to have, when I started seeing the first big red numbers in the market starting to go on that roller coaster ride, I was expecting a lot worse right now. And this is not saying that this is done right now, but I'm just saying that right now it is a great time to be invested. And this is another, probably one of the biggest points I want to make out of this video, guys, is right now, how do you sit financially? We got the Trump stimulus payment check going out. We got everybody starting to receive anywhere from $1,200 to $4,000. I just received mine, 2 days ago. To be quite frank with you guys, I received, $2,900 from me, my wife, and my kid. And I like to think that we could use that money. I know that somebody could definitely use that money more than us, and I honestly feel a little bit selfish getting it, but we do have some needs and costs that did arise from being in the military and having to move across the world. We had some appliances that we definitely had to get for our house, so it was honestly really nice to get that money, because what I had to spend was almost like $1,400 to get things that our house just needed, like a washer and dryer essentially. So that was part of that cost there. But it was really nice to get that. And then to let you guys know what else we've done with the money, honestly, I've just stashed it into our cash account. I kind of built up our cash portfolio a little bit larger. I wanted to have a little bit larger of a cash holdings. Now, a lot of people think that you have to have like 6 months of bills saved up. I think that's a little much, dependent on how stable your job is. Now, I could tell you right now that I think if you were to become debt-free and before having a crisis time like this where you could potentially lose your job, I think it would really negate a lot of the downside emotional effects you would have when you don't have any more income coming in, when you don't have consumer debt, when you don't have credit card payments, a car payment, when you don't have things just straining your debit account or your bank account. it really eases your mind because you don't have so many things to pay for. So it's not such a big deal if you are to be, you know, temporarily placed on furlough, which is huge right now. I know there's like Disney out there, you know, furloughing 45,000 employees or something insane like that. You know, just a few weeks ago we had 6.6 million people filing for unemployment. It is absolutely insane right now. And guys, there is no better of a time to be debt free than going into a time like this where your job could be possibly on the line. I can't stress that enough. And a lot of people ask, should I be paying down debt? Should I be investing? Well, if you've gotten to the point where you're debt free prior to a time like this, I think you have hit the nail on the head, in my opinion, especially if you're somebody that has been able to maintain your job all the way through, because then now you're not worried about paying your debt down. Now you can take those same dollars and you can invest them into this market that is creating some serious opportunities to create exponential wealth much faster than what the rule of 72 is going to offer. I just wanted to show you guys what's going to be coming up in the next couple weeks here, especially in this next week with earnings. A lot of people are holding on to money right now. They're kind of, you know, curious, what are the earnings calls going to provide? What kind of information are we going to get about a lot of the specific companies you guys want to invest in individually? So starting here, I'll scroll through these. You guys can see over the upcoming week here that there is a lot of financial companies that are going to be reporting their earnings here. You got Johnson & Johnson, some other big names, Procter & Gamble, JP Morgan, you know, United Health, Bank of America, Abbott or Abbott Laboratories, I believe that was a spinoff, right? You got Wells Fargo, Honeywell, Citigroup, BlackRock, which I believe manages the thrift savings plan, if I'm not mistaken there. AMD, another huge name, Morgan Stanley, Goldman Sachs. Again, just some massive financial companies in here that are all going to be reporting, you know, their earnings here. And something to think about, guys, too, is I know Graham Stephan, another big YouTuber, had I think he released a video about, you know, tenants not paying their rent, tenants not paying mortgages, or people that have, you know, loans for their house and stuff. And that's one thing that we haven't seen yet with all of the layoffs. People on average have, you know, somewhere around $1,000, maybe a little bit more saved up. I would hope that the average American that owns a home has more than that saved up, so that they can, you know, put food on the table, keep the lights on, and pay their mortgage or pay their rent. But to be quite honest, guys, with all of the furloughs, with all the layoffs, ensure the Trump stimulus package will definitely help people in need in order to keep the lights on and pay the rent. At some point, there are going to be a large number of people that do not find a job, that do not go back to a job, and that cannot pay their rent or pay their mortgage on their home. Now that is what I'm interested in seeing, is because it reminds me again of the 2007-2008 crisis, where people are defaulting on their houses and everything is going into foreclosure. I don't think that's going to happen here, but I do think that, you know, this could happen to a, you know, degree. I'm interested to see how the earnings go over all of these financial companies over the next 1 to 2 weeks here. I'm curious to see how the market reacts to, you know, what is probably going to be not a sexy earnings call for many companies here. And when I look at the stock market, it just doesn't seem like it's reacting the way it should. So again, they're two different things. You'd think they'd be in parallel and sync, but they just don't seem to be. So I'm going to look at these earnings calls over the next week. We'll see what's happening here next week. We got, you know, big companies, Amazon, we got Google, Johnson & Johnson having their annual general meeting, Visa, another great growth company, Nestle, Verizon, AT&T, Coca-Cola, Bank of America. That's just their annual general meeting. So not all of these are earnings calls. If you just look over to the right here, some of them are earnings, some of them are just their annual meetings. Pfizer having their meeting, Netflix having their earnings. So again, some massive names, guys, here in the next couple of weeks. So that's something else I would encourage you to do, is if you're looking to enter into a company, look and see if their earnings is going to be coming up in the next few weeks here as we do enter earnings season, as sometimes the stock or share price can get a little volatile dependent on what news comes out from the executives of that company. So this is my Roth IRA, guys. Thank you for anybody that has stuck around this far in the video. I really appreciate you. Thank you guys for liking the video. I appreciate you guys subscribing and commenting below. It really helps this video get recognized by the YouTube algorithm and get pushed out to other investors that need good information here. So this is the Roth IRA. this account, guys, all of these dollars that I've put in here, all this 13,500, some of this is made up from capital gains, and a majority of this is made up from money that I've put in here from my paycheck. So that money has already been taxed, and I have now put it into this account, and it is in here to grow tax-free. So if this 13,000 was to grow to 50,000 over the next 20 years, then all this money up to that 50,000 would all be tax-free. That's how the Roth IRA works, and that is the beauty of this. Uncle Sam has already taken his portion of the money I'm putting in here, and this is the beauty of a tax-protected account. So that is what I mean by when I say tax-protected. I mean the taxes have already been paid on this bad boy, and everything from here on out is just gravy, baby. So I'm going to show you guys how far this account is down. This is kind of inaccurate right here. It shows you a 0.5 return over all time, but I'm going to go to holdings here, and we can see that my account's actually down about 700 bucks, so about 5%, about 1% higher as far as capital losses go compared to my more conservative pie, which is my dividend pie, or my dividend investing account, which I showed you guys originally in this video. Pretty interesting to see some of the stocks here. If it wasn't for me buying, freaking Tesla at almost $800 a share. Now I do hold quite a bit of other Tesla in my wife's Roth IRA, which I'll show you guys here, which I bought at about half this price. So that's what makes her Roth IRA so much better as far as the returns go, as so much better as the cost basis goes and the average share price. I bought Tesla really high in my portfolio and then really low in her Roth IRA. So I'll show you guys that, but in all honesty, our accounts are all together, so it's kind of like an average. So I'm in Tesla long run. I think that over several years they will pay me handsomely, and right now I'm down 8.7%, so it's not that much. In the last week they have honestly ran up so much. They have been doing great, and it's one of the stocks that I was talking about that has reacted completely opposite to when the market is, what the market is doing. When the entire market, I'm talking about majority of all the stocks on my watch list, I'm talking about the S&P 500, the NASDAQ, the Dow Jones Industrial Average, all those are down anywhere from 0.5% to 4%. Tesla's over here up like 10% on a day like that. They react completely opposite to what I'm seeing how the majority of the market reacts, and that is kind of crazy. But they have done very well in the last few weeks, and even me buying this at $797 in average share price in this portfolio, it's only down 8.7%. That's pretty crazy for how high I bought it. So we can see that this account's down 5%. And guys, 5% is nothing right now. If we're to go down more, okay, I'll just keep buying. I'll keep averaging into these companies as I can put cash into this account. But I want to show you guys the other Roth IRA and how that one has performed through this time. All right, so this is our other Roth IRA, my wife's Roth IRA, which I have done so much better in compared to my Roth IRA. This account is only down 1.28%. So only like 1.3% essentially down out of all this craziness in the market, out of all the volatility. But again, I have some more cyclical plays in here. I've taken advantage of some of those beach style of stocks we talked about in previous videos and bought some of them at much cheaper prices. Now again, this is like the best of the best out of all of our accounts here, buying things at great prices essentially when the market has timed them to be pretty nicely. So having things like Carnival Cruise Line in here, buying it at $9 a share, I mean, that is very low, and that's a very cyclical stock. No one's to say that this can't go back below $9 here in a day or two. That's literally how it's just having like mood swings. But being up 34% on that position right now, like it is definitely lifting the other positions in this portfolio that are down more. Now, when I talk about Tesla in this portfolio, literally being like it's dang near half of what I bought it in my portfolio, just to show you guys that I don't try and time the bottom. In my portfolio, Tesla is a company I believe in long term, so I bought it for the exponential growth that I think it has the capability to have over the next couple of decades here. Now, I bought Tesla here because I bought it all the way down, and seeing that it was at a value, in my opinion, at $412 a share, I thought this was an absolute steal, and so I put a little bit of money. I wish I had more at the time to put into there, but of course, we only had $335 to put in, and now it's up 77%. So you cannot complain with a return like that, and especially during a volatile market right now, to be only down 1.28%. I do see this Roth IRA getting to $100,000 probably before my other Roth IRA. Now there is one account that I'm not going to show you guys today, but I will tell you that I have a couple $1,000s in, and that is over on Fidelity, and that's my other portion of my Roth IRA. So this one is, you know, a little bit ahead right here, given that I was investing later in the year when the prices were a little bit better, when the sales were a little bit better in the market for this specific Roth IRA. But just to show you guys, no matter what, on the companies that I really like, the companies that I believe in, I'm constantly investing into them. I'm just kind of dollar cost averaging. And when the opportunity does present itself to deploy a little bit more money than, you know, the average weekly you know, investment, then those are the times where I love to go out and have cash on the side, where I have a couple $1,000s saved up that I can deploy into a specific company that is saying, hey, I'm on sale, I'm a great deal right now, you should pick me up. Alright guys, that pretty much wraps up today's video. I appreciate you guys liking, subscribing, and commenting below. Thank you so much for doing all of that. I appreciate all my new subscribers. I hope you guys gained some value out of today's video. If you have not, please let me know. If you guys do like the videos, again, show your love and support by smashing that like button, and I'll see you guys in the next video.